All right, good morning, everyone. We're here at the Dalton Wade Real Estate Group Saturday morning training meeting. We're broadcasting live on Periscope, and we're also videotaping it for it to be on YouTube. We've got Perry, Brenda, Andrew, Lisa, Micah, Steve, and Claren. All right, so today we're going to chat about financing condominiums and townhouses, and also talk a little bit about working internet leads. So a lot of these training meetings come out of questions from agents that kind of came up during the week, and I figure if they had a question or there was something that they didn't understand or was thinking about something not exactly spot on, would make sense that there's probably others. So we figure we kind of generate a training session out of it. So some of the laws, the lending laws, have changed a little bit about financing condominiums. Previously, you had to have an owner occupancy, and this is all sort of just generally speaking. You had to have owner occupancy above 50% in order for a lender to finance against that condo association, and that would be a conventional lender, someone seeking conventional financing. Those rules have actually changed. So now it basically works like this. So if someone is putting down 20% and they're a conventional buyer, it doesn't matter what the owner occupancy rate is. You can have less than 50% and still have that association be financed. If they're a conventional buyer and they're putting down 15, 10, or 5%, then it's up to the private mortgage insurance company. So the Fannie Mae and Freddie Mac guidelines say they'll lend when the owner occupancy is less than 20%, less than 50%, and the person is putting down less than 20%, provided that the mortgage insurance company, so when somebody puts down 15, 10, or 5, there's private mortgage insurance required. So the private mortgage insurance company is the one that has to be okay with the owner occupancy being less than 50%. So kind of what came up this week was one, I've got a client, they're going to be putting down 5%. The first lender I spoke to said they needed 70% owner occupancy, which this place didn't. And then the next lender said they could do it, the owner occupancy didn't matter. And then I talked to a third lender who I've worked with for a long time, and she sort of explained to me, what ends up happening is it's really a function of who the private mortgage insurance company is that they're using. So in this case, the one that needed, the 70%, those were the requirements of his private mortgage insurance company. And then the person that could do it with no sort of owner occupancy requirement had a private mortgage insurance company that could do it for, it didn't matter. So they would find.
Was this a pre-construction sale?
No, this is a regular existing, condominium association. So basically there's a lot here to kind of digest. So there's three groups of people that are potentially buying. So you've got investors, you've got second homeowners, and then you've got people that it's going to be their primary residence. So what I just explained only applies to primary residency and second homeowners. So for those folks, if they're wanting to go less than 20% down on a conventional loan, provided their lender has the mortgage insurance company that'll finance it, they can do it with 5, 10, or 15% down. Now, what ends up happening, and this kind of takes it one step further, so if the person is putting down 15, 10, or 5% conventional financing, there's called a full review of the condo association. So, and that generates a 3-page, 25-question questionnaire about different things that are going on with that association. So for instance, even though the owner occupancy doesn't matter, here's what does matter. If there's a lawsuit against the condo association, no financing. If the condo association isn't reserving more than 10% in their budget won't qualify. So the total income in is 100,000, but their budget is only 8,000 for reserves, won't qualify. If one person owns more than 10% of the units, more than likely it won't qualify. If more than 10% of the people are delinquent on their condo fees, won't qualify. Those are the main questions, that kind of come out of the condo questionnaire that can trip somebody up. Now, if somebody's putting 20 or 25% down, then they issue what's called a limited review. And typically the limited review it's really more focused just on, is there a lawsuit against the condominium association? If there is, that lender's not going to be able to do it. Maybe through a credit union, somebody that's going to actually be keeping the loan would be able to finance it. So even though your client is putting 20 or 25% down and there's no lawsuit, you might still call the management company and ask those other questions, because basically they're going to be buying it, but then in the future when they go to sell it, there's a whole bunch of people that can never buy in there, because if the situation doesn't change. So that ultimately affects the value, because there's less people that can purchase.
So where did we find this information about the lawsuits or the conduct and delinquency and all this information?
Yeah, the management company.
Okay.
Or, if there's not a management company, then the homeowner.
Okay.
So sometimes, have I ever helped a homeowner that owned a condo association actually put together a budget? Yeah, I've done that, So, and again, it is, like many things, it's black and white. 10% greater in reserves, good. Less than 10% in reserves, not going to get financed. And this is all conventional financing. And this is all for condos. There's also, that kind of came up this week, oh, it's a townhouse. Okay, so there is no such thing legally as a townhouse. It's either a condo or a PUD, which is a urban development, planned urban development. So if it's a PUD, then usually there's a homeowners association. And in that case, typically the person owns the land, they're maybe responsible for the roof, where in the condo association, it's the condo association that owns the land and owns the roof. So the difference, and where it gets tricky, so if it's a PUD, you're fine to lend against it. It becomes more like a family home if the unit is actually detached. So it's a separate kind of freestanding unit. When it's attached, so you've got, because people say, oh, it's a townhouse, and they're thinking it's kind of the up and down, it's a style. So but there's no townhouse designation for a lender. There's only PUD or condo association. So if it's a PUD, there's a homeowners association. Now, if the townhouses are attached, then it probably for your lender, it probably falls under the rules of the condo. If it's detached, it's much simpler. There's no questionnaire. It's a lot easier to finance. So just to kind of keep that in mind. So if it's a homeowners association and then the units are attached, one treatment. If they're not attached, another treatment. If they're not attached, it's usually viewed more as a single family dwelling. And then all that sort of, questionnaire doesn't apply. So that's kind of how that works.
And my own story, like before I come to real estate, I bought a condo in Valhalla in London.
Yeah.
And whoever the real estate salesperson was, I was not in, my wife did all the closing, everything. I was in Seattle. After we moved in, we found out that the minimum owner occupancy is supposed to be 2 years. We never know the main restriction on it.
Right.
I was trying to sell it. That's the time I found out, hey, you didn't even live here for 2 years. I said, so what? It's my house. I just want to sell it. They said, no, you cannot.
Right. So they're in the disclosure on MLS, you'll see minimum occupancy before you're able either to lease it, and in Perry's case, you couldn't even sell it. So again, that's all going to be laid out in the condo documents. So a lot of times when it's a condo, someone may want to have an attorney read those. to kind of make sure that the person purchasing it understands like exactly what they're buying. So they are a little bit trickier. And then the homeowners association. So again, if it's a single unit, the lending requirements are much less. If it's attached, then it kind of, even though it might still have a homeowners association, it's going to fall into kind of the rules of being a condo. Even though it's not technically classified as a condo, the lender's going to think of it because it makes sense, because now you've got a shared roof, you have shared walls, you may have shared land, and that's kind of what sort of makes the distinction.
The risk profile is the same as a condo.
Right. The risk profile becomes the same as a condo, and if it quacks and waddles like a duck, it's a duck. So that's and again, for the lenders, there's no townhouse. People, it's a town. No, there's no such thing really from a lender's. And again, even if you have a cash buyer, to kind of help them think through all this, because what it does in the end is it affects the value of what they're buying into. It's a lot harder if the only people that you can sell the property to is a cash buyer, because nobody can get financed on it. It's got a legal suit against it. Hopefully they're able to clear that up quickly, because it becomes very, very difficult to sell it. The only person that can buy it is a cash buyer, or maybe somebody who's getting a portfolio loan. But any type of Fannie Mae, Freddie Mac product, conventional it won't fly. Now the other thing to always keep in mind. So now we talked about conventional. Now we're going to talk about FHA and VA financing. So you've got an FHA buyer and a VA buyer who wants to buy a condo. So in that case, all of the above rules still apply, except that now the condominium association has to be approved. So not only does the buyer have to be approved, the association has to be approved. So if the association's not already approved, then the lender has to go and get it approved, which is about a 30 to 45 day, sometimes 60-day period to submit everything to HUD to have that approved. So again, that seller's got to wait much longer for closing. Are they willing to kind of go with the buyer? The approvals last for 2 years. So once an association's approved, that approval's good for 2 years. So if it's FHA approved, and FHA and VA are, for all intents and purposes regarding this, the same. If it's approved, then it's approved. The approval lasts for 2 years. It does expire. Hopefully the management company just renews it and it continues on. Because if you think about it from sort of marketability, value, it's good that it's approved, because it opens up who can actually buy.
And so few are approved.
Yeah.
That it's really hard to find one that is.
Approval probably asked those same questions that you asked earlier. Those 4 questions.
Well, yeah, they're still there, those questions, but then they're also going to get into, it's much more thorough. They need, surveys of the property, of the whole association. It's very detailed.
The insurance.
It's much more in terms of the questionnaire. So it's really on another level, and we've done a few previously, and it's a pain in the butt.
I know it took 6, 7, maybe even 8 months. It was
to get it approved, but eventually, the buyer and seller hung in there.
Only two units in the 2 people.
A lot of times you need an attorney letter. There's a lot that goes into it, so that's why if you've got an FHA or VA buyer and they're thinking of kind of going the condominium route, you can really only be looking at ones that are already approved, or possibly go through the rigmarole of getting it approved. Bigger complexes are kind of easier to do. They've got more resources to sort of be able to get all the paperwork and documentation. It's like anything going to the government. It's more the file has to be complete. All the I's have to be dotted and the T's crossed, and if it is, they get approved, and then the approval's for 2 years. So, and all this kind of goes back to just, getting tripped up. So you've worked with a buyer for a while. They finally put an offer in, and it got accepted. But then you, as the agent, didn't really know all this, and they can't get the loan. And then you've had them do a home inspection. You've gone all the way to the underwriting, and then you get blown out of the water. So you want to be finding all this out in advance. You do have in advance, what like the offer I put in, I asked four main questions up front. Any litigation against the association. She sent me the budget. I could see there's 10% reserves. Does anyone own more than 10%? Nope. Is anyone delinquent? One person who was delinquent a few. So everything kind of checked out. So I felt good enough. Okay, now we can move to the next step and then kind of get the condo questionnaire answered. So, but if you didn't ask those questions in advance, and then you kind of find out there's a problem, you wasted a lot of time. You wasted maybe some of your clients' money on the inspection, and something that easily could have been figured out before, you kind of missed. So
Kind of like the 4 red flags that you want to just
right.
check off right away.
Yep. And so that's kind of how it all sort of comes together. So, you've got different types of financing, you've got different types of legal entities, condo versus PUD, and then within the PUDs, you've got attached and detached. Then you've got these. It's a little tricky. That's why buying a single-family home is a lot easier. It's a lot less work for a real estate agent when they're working with a buyer. But you do need to know all this because there are a lot of condos here and things will come up. So, any questions on this?
And if they're an FHA or VA buyer, they have to have a lot of time to, if it's not already approved. I mean, they might need to wait months.
They might need to wait months. And, the other thing, too, is that a lot of times the seller's not even going to go there. Like if I've got a seller and then, I'm going to explain to them what the process is, it may not even make sense to go there. It may just make sense to wait and find the cash or conventional buyer as opposed to, because again, there's no, like I had one, I remember, it was a 2-unit one, and we ended up getting tripped up on the budget, and it was a manual budget and we couldn't meet the reserves and, in the end, it didn't get approved. So, everybody wasted a lot of time where we could have been out there sort of looking for, a conventional buyer. So the conventional buyer, there's a lot more flexibility in terms of, purchasing a condo. But again, within kind of the guidelines of what we just talked about. So the thing is, when you get to, you've got somebody that's 10% down, they're wanting to buy a condo, just talk to their mortgage company first. Find out what they need. Everybody is not exactly the same in terms. Like, I had one guy said they needed 70% owner occupancy. The other said no, owner occupancy is not an issue. And the reason was because one guy used a different mortgage company for the insurance, and then that mortgage company has sort of the final approval of whether they're going to insure that loan. And in that case, the guy was 70, that's what his mortgage insurance company required, and the other one had one where that wasn't an issue. So
Is 70 rare?
70's high. I mean, it used to be 50-50, and it used to be that below 50, there was no mortgage insurance companies that did them. So it just wasn't even, if it was 50% or below, it wasn't financeable. Think of it like this, the financing is it's a product. Somebody's come up now with a product that basically says, okay, I will finance a condominium that has less than 50% owner occupancy. And in this case, it's actually the mortgage company saying they'll do it. So if you think of it as like, that's why sometimes somebody can't get approved here, but then another lender may have, that's why sometimes like a mortgage broker is actually good because they have, they may have more things sort of in their quiver than like a bank. A bank is just, going Fannie Mae, it's a little bit more stringent. Like I had an FHA buyer buying a single family house. She had like a 580 credit score, unfortunately. She did have a lender that would pre-qualify her. She might have been able to get the loan with that credit score, but then I sent her to another lender who was with a bank, and their minimum was 640. So she didn't have that. So she couldn't, even going FHA, she couldn't get finance there. So she decided to wait, build her credit score back up, because they end up paying a higher rate, and sometimes there's additional fees when they have the lower credit score. So it's, you know, it's not like, you know, black and white. There's variations, and these things are always changing. One product's available today, a week later they don't offer that product anymore, and what you thought you could get financed now, you know. So when it's a little bit out of the box, that's kind of where these things come out.
So everything you just talked about since we got here is for if it's somebody that's going to own or occupy the house. It doesn't apply to investors.
Right.
So if your buyer is an investor, there's different rules that
Yeah, I
we
mean,
covered, right?
We can talk about that. I mean, if they're an investor, typically it's, again, 20, 25, 30% down. And where those amounts come from is from the lender. So, you know,
Is that the same for a second home?
no, second home falls into the primary residence.
What is the 10% budget part? I don't understand there, Bill.
Okay, well, the 10% budget, that's the reserve. So somebody's, so there's $100,000 of condo fees collected, and then there's $89,000 of budgeted expenses, you know, insurance, flood insurance, you know, maintenance, lawn care, you know, whatever their budget is. And then it comes down to, there's $11,000 of reserves. So the reserves are being built up year after year, so that their capital, like it's a capital contribution for reserves. So then in 5 years, when the roof is needing to be replaced, they have
You're able to do it.
they have the money sort of in the kitty to be able to do it.
It speaks to the management of the association.
Right. And again, it's not the actual, it's kind of, you know, I mean, they don't look at the actual expenses. They just look at the budgeted expenses. So as long as the budget shows that there's 10% of what they're collecting going into a reserve account, you know, that requirement is fine. But if it's less than that,
It probably doesn't happen that much, though, that happens.
well, where it happens, it tends, when it's professionally managed, you would hope a professional management company has been through this issue and kind of knows. If it's individually managed and there haven't been any sales, they may not know of it. They may not want to put that money into, because it all comes out to, you know, you're collecting the money. So, I mean, I've got a condo, you know, that's like 859, it's 6 units. They don't put any money in reserves. So that, you know, is not financed. Now, again, the reserves, right, is on the full condo questionnaire. It's not on the limit.
It's not on what?
It's not
Review only.
right.
It's not, yeah.
It's not on the limited. So there's 2 reviews. There's a limited review, and then there's a full review of the association. On the limited review, the reserve question is on there. On the full review, that's on there. On the limited review, they don't ask that question, because think of it from the bank. Now they've got 20% equity, as opposed to, oh, we've only got 5% equity. And what they're afraid of is that, you know, there's no money to kind of keep the place up, and therefore their investment and their collateral deteriorates.
Well, yeah, because if the place shuts down, the lenders kind of...
Yeah, well, they're sort of hanging out there exposed. It's the same thing about, you know, why if, you know, more than 10% of the people are delinquent. You know, they're not collecting the money to be able to keep that... Right.
Yeah, simple example.
So it's
where I live in
basically
Brandon,
just the place.
there's a condo division called Villages of Bloomingdale.
Mm-hmm.
And it was like, I heard from 5 years back, it was nice. Now the association is running out of money. Very poor, broken gate, no lawn,
Right,
no
right,
sun.
right.
So everybody trying to run out. Now too many houses on sale or on auction. It's all bank owned now.
Yeah, they won't
Like
touch
at least 20 properties are owned by bank.
Right.
So every week you see them in the paper, they say, we are auctioning the property, as it is. But next to that, there is another subdivision which collects some money. They keep the place so beautiful. People die to pay more rent and to move in there.
Right. Yeah.
The central question is risk to the lender.
Right.
Yeah.
Even concentrated ownership, like you're saying, if you don't want any owner to own a whole lot of it, that's another risk. It's a slightly different kind of risk.
Right, because if that person goes bad, and they, you know, run into financial difficulties, then they're gonna stop paying their condo fees. And if they own, you know, 25% of all the units, now there's a problem there. So,
I once lived in a 10-unit condo, and when I wanted to sell it, of course with only 10 owners, nobody wanted to pay anybody to do a budget or do any, there was no homeowners association.
right,
So when I wanted to sell it, I had to do it myself. I had to like make up a budget, and
Right.
I had to do all this just so I could sell it. But if it's a small unit, you're not paying anybody to do this, and 10 owners aren't going to put in reserves or even pay anybody to manage it. So it
It gets-
seems like the smaller ones, you know, they're kind of more.
Can you have a condo in Florida without an HOA?
yeah.
Oh, really?
Well, I mean, the documents are there.
Right.
People have just,
But actually, people are not doing anything. Not
right,
putting-
I
not
mean,
putting any money into
the
it.
condos,
They're not paying anybody
right,
to do
it's
it.
not,
Right.
it's not active. So basically, you know, everybody's just kind of taking care of their own. You know, I have a friend that's the
Hoping the
situation.
roof lasts, I guess.
What?
And hoping the roof lasts.
Yeah, and hoping the roof lasts, and then there's no formal, and then that's all, again, it's all fine, but then no lender's gonna lend there, because there's too much risk. So again, and then what happens is, and I've seen it to the point where it's about a 40% hit in the value for what a cash buyer will pay versus what, you know, a nice strong condo association. So like units, you know, it's going to sell for a significant discount, because nobody, you know, and again, if you're buying in there, you're limited to who you can, and then it tends to attract more renters. It's just, you know, it's kind of just a downward spiral.
What's a 40% difference in value if it's a cash buyer versus?
If it's it's called a non-warrantable condo association. So you can't warranty, you know, the association. So when they're non-warrantable, that's just been my experience. Maybe it's less, but it's still, you know, it's going to sell for, and you don't want to be putting, you know, sometimes like, oh, you know, it's like on the cusp, you know, in terms of, you know, the number of delinquencies. And I guess that can be cleared up. It used to be, you couldn't find a lender. If it didn't have 50% owner occupancy, no lender was touching it.
It used to be black and white.
Black and white. Now, you know, they've loosened up some of the rules, and which is helpful for people who own condos. But, you know, as I mentioned, that one lender, he had the mortgage insurance company that needed 70%. You know, if you're going in with 5 or 10, now that's not, so somebody buys in, right? They now own it. Things start to go, you know, a little bit bad. 3 or 4 years later, the rules change. So these are not like fixed in stone. They're like here now, maybe there tomorrow. So that's, again, kind of a risk. Condos, I mean, they're riskier in general. And that's what you kind of need to, you know, help your client understand. I mean, you don't want to be scaring them, but, you know, they kind of need to go in, you know, with their eyes wide open in terms of, okay, what am I actually buying into here? And they have to feel comfortable with that.